Welcome to the Jay Tyner Show, where we discuss all things wealth management and retirement planning. And as always, the goal of our team here at Semmax Financial Group is to help you focus more on your life and less on your money. Now, as a reminder, check with your current advisor, planner, CPA, and read our disclosure in the video description below. Subscribe to this channel if you want to stay up to date on all of our new content. And by the way, if you have questions or need a 15-minute free consultation, please visit semmax.com or call 336-856-0080.
Hello and welcome. Today we have 5 tips for retiring in a volatile market. I am joined by Jay. Everyone recognizes Jay, and then also Mr. Michael as well, and then I'm Matt. So let's dive right in. 5 tips for retiring in a volatile market. Number 1, Jay, you want to take it away?
Well, I think if you're going to retire now in this type of an environment that is pretty volatile, you really have to reevaluate or evaluate, either way, your current risk tolerance. So that means how much tolerance do you have for a lot of risk? And I think that's a very confusing situation for most people because they get really emotional when they see the markets going down, but you still have to have a balanced plan. So it's like if you're getting ready to fly from here to from Greensboro and you're going to fly down to Dallas, if it's a day that you show up at the airport and there's thunderstorms, all right, you might be a little more concerned about the volatility of flying to Dallas. But what are you going to do? You're going to still get on the plane and probably fly.
You're going to buckle up and make sure you're comfortable.
I will say this. If it's Hurricane Ian that's come in through, right, you're probably not going to be getting on a plane and flying, right? They're going to say, nah, can't do it. So again, it is important. It doesn't mean you shouldn't retire. Just means that you probably should start seriously evaluating it. And I think there's a couple tools that we have here at Semmax Financial Group to actually do that.
There's some great software. And then also I feel like there's no substitute for that face-to-face, kind of uncovering how you're really feeling. Yeah,
that one software, though, kind of gets you left brain, right brain. It really separates those issues because right now you might actually come out on your gut. My gut might be telling you, hey, I don't want any risk. When you still might need risk because you're not retiring for 1 year, you're retiring for 20 or 30 years. So you got to have your money working for you. So,
that's a great point. Yeah. That's a great point. Now, Michael, number 2, what's the second thing?
Well, the old saying, don't put all your eggs in one basket. So that's part of it. And Jay mentioned balance. And really what they mean when you say don't put all your eggs in one basket is it's okay to have everything at one firm, but you don't want to be all in one sector or one part of the market because really there's 50 different sectors to be in, and any one may perform well in a market like this. Others may perform not so well, and then others, are just kind of hedging in between. So really it's looking at the overall, let's diversify, let's be in different sectors of the market so that, when the market's good, we've got a portion of it doing really well. The other portion maybe balances things out when we see volatility like we have today.
Yeah, I might add to that, having correlated assets that are correlated to the market and then having non-correlated assets, some of those assets that don't go up and down when the market goes up and down. So
an alternative or a hedge to just what's in the market. Yeah.
And of course, Semmax, we have a couple of those available, and they've been doing very well.
They have. And I like number 3 here. I think it's important for you to review your cash reserves. And because when we think about volatility, oftentimes folks think about it from the negative standpoint of, okay, this means the market's going down. Well, what this means is big movement. This is a lot of swings. So you may be in a position where you're looking at that cash reserve and saying, okay, I may need to raise it a little bit. I want to be a little bit more comfortable. Allow me to have an appropriate risk tolerance. Right? But it also may be a situation where you're looking at and saying, this is a good time for me to take some of that cash that I have on the sidelines, reevaluate how much do I really need to be there, and could this be more of a buying opportunity?
Sure. I've said that so much is we're the only industry that when things go down and they go on sale, nobody wants to buy. It's like, what's going on?
That's exactly it. Black Friday sale, things are 30% off. You go, that's a great jacket. The stock market, things are 30% off, and you go, what's wrong with it? Yeah, I'll buy it when it's full price.
You were down in South Carolina, and that you came across that really nice Italian-made blue blazer.
Yep.
And they were discounting that thing like, what, 40%?
Oh, yeah.
Crazy. Or like almost giving it away. What'd you do?
Well, I bought it.
Yeah, but you looked at me and said, "Oh, you think I should buy it?"
I did because
So,
I
right.
yeah. Well, in every marriage, there's one spender and there's one that's not, and my wife is the spender.
So that could be the same thing when the market's down like this, and you have that cash reserves. One person's like, "Oh no," and the other one's like, "Oh, we should." Hey, come in and get a big picture review. Sit down with his CFP and just kind of go through the numbers. See if
That's
it works.
it.
Yeah.
That's it. Now, at
Buy
the
that
same
blazer.
time, we don't want to be totally ruled by our emotions, and I think Michael is going to speak to that as well. So, what's the next one for us here?
It's really difficult to again not be influenced by volatility and your emotions. To be honest, like it's stressful. The market's going down, and you're going to retire in a year or two or next month. You feel like I got to do something,
Right.
but we're here to help kind of take a step back. Let's look at the big picture. Don't be ruled by your emotions, especially with your investments. If you have a plan in place, you have a understood risk tolerance. There's going to be many more ups and downs in the markets over the next 30 years during retirement. So why make a change right at the time that you are retiring at the wrong time? Nobody can time the market right, especially twice.
I would say this though: when your emotion starts really getting high, that's a good time to kind of check in with your advisor.
Right.
And if you don't have one, then you probably need one. But if you have one, it's like that's the perfect time. So let those emotions rise, but don't just sit at home and be upset and angry and tell everybody else. Check with your advisor, and there's so much to that in getting that second opinion, if you will, or that feeling that, all right, I talked with my advisor, he's explained things. Maybe it's not as bad as you thought. How many times does that happen?
I can't tell you how many times in the last 6 months I've had somebody go, tell me how bad it is. I'm scared to look at my mail. And then I tell them where they're at, and they go, oh, well, that's not what I thought I was in at all. And it's because they're getting so wrapped up in the emotions of what's happening in the stock market, about what's happening on the news, that they don't realize, well, wait a minute, you're not matching exactly what's going on in the NASDAQ.
Yeah. Well, but we're talking about retiring. So if they're retiring right now, again, it may not be as bad as you think. Just because you look at your accounts, they're down pretty low. Oh my goodness, I don't think I can retire. How many folks have come in and we were able to build a plan, even in a down market, and they move through that?
That's very true.
Yeah,
that's very true. And then that actually ties in with the last point here, which is plan, and then don't abandon your plan. I can't emphasize that enough. Oftentimes people go, well, wait a minute, I was planning on retiring. Now we're in a volatile market. Can I still retire? I thought I was going to be okay. Am I? I think it's important for you to be planning on the front end, but then when you end up in this volatile market, don't abandon the plan. Don't throw it away. This is a time to look at it. Do we need to make adjustments? Do we need to reevaluate our risk tolerance? Do we need to keep our emotions in check? Do we want to make sure we're diversified in all of these different things? But all of that falls under the umbrella of that plan. That's what comes with working with an advisor, thinking through things, having these conversations, and you may end up making adjustments to your plan. It's like anything else. If we're planning on going to the beach and there's a giant pile up on 40, well, I might make an adjustment on how we get there, but I don't just all of a sudden abandon the idea of going to the beach. We make adjustments. We get through it.
Well, can I make number 6 tip here?
Absolutely.
So don't procrastinate. A lot of people get concerned and they wait and they wait and they wait when they could have had a plan and they could have retired and they moved right through it in a bad way. So don't procrastinate on this. Again, if your emotions are up, you're thinking about, can I retire now in a volatile market? You probably can, but you need to come in and get the numbers.
So here you have 5 tips for retiring in a volatile market with a bonus tip from Mr. Tyner himself. If you'd like to come in and speak with us, please don't hesitate to reach out. You can reach us at 336-856-0080, and one of the advisors, either myself, Michael, Jay, or one of the other very competent, very professional advisors in our office would be glad to assist you.